in terms of that process. So I want to get started now with regards to, so let's make sure I'm sharing my screen here for everyone. So welcome. Well done to all of you who've just been part of the sharing session. And can you believe I'm actually fascinated? We're in November. This year has flown by. We've got a number of new participants that have joined us. So we're really, really excited to be welcoming. There's a number that have joined us from Susanna to Nozipo to Nirvana and Alan and Damien. So welcome to all of you in terms of the process. It's wonderful. I'm not sure, Alex, if I'm missing anyone, please let me know. But it's really, really exciting. And I think what we're going to be doing today is it's going to be a very powerful session for you today. There's a lot of really, really important info. So I can see Anthony's joined, so I don't want to take any of Anthony's time. But just to remind you, this is always our focus in terms of how do we diversify across countries, currencies, assets, partners, and time, and how do we build passive income? And we've broken it down in terms of the process into 9 steps. And I'm going to go through them once Anthony's finished. But in simple terms, this session that we go through now is step 8 and step 9 in terms of the process. So just to remind you, the Mastermind sequence, step 7 is where we do a check-in every month. So it's the group accountability. And we are going to use the PWG platform going forward, which I'll share a bit later. And then you've also got the ability for hot seats. You can either do it early in the morning, you can do it an hour after this current session, or you can do it this evening at 8 p.m. And then you've got steps 8 and 9, which is where we do the market review with Anthony from Calio. We do a deals review with the private equity team. We've got one main theme, one learning theme per month. And then we've got the admin for the month in terms of the overall process. Some people say to me, why do we repeat things over and over again? The simple answer is that repetition is the mother of skill. So doing something over and over again is what is going to help you get your results. And that's why we work and try and work every month on countries, currencies, assets, partners, time and time management, mindset and strategic thinking, execution, accountability, and investment and review. And so without further ado, it is time to hand over to Anthony. Anthony, quite a month with Trump and the Republicans winning a fairly landslide type victory. And I'm not really interested in getting into a political debate as to whether people are happy or sad about who got into power. But I think what is quite important is what does it mean to our investments. So over to you. And as always, thank you for joining us.
It's a pleasure. Morning, guys. Yeah, Scott, quite right. A very busy month. I think October, which we're going to look at now, was quiet in a sense. There was a lot of build-up and I think anxiety in the market towards late November, obviously with the late October, obviously with the elections taking place on the 5th. We'll dive into a bit of that. I didn't want to take too much away from next month's presentation. But quite right, a lot of activity over the last couple of weeks. I'm going to just share my screen here. Alrighty, can you guys see that?
Yes. Yep, got you.
Fantastic. All right, as I mentioned, looking at October, like I said, a lot happened in November, which I'll touch on briefly, but a lot of these slides do focus on October. In terms of the usual format, looking at our major indices over the month, we can see, without diving into too much detail, we can see that it was largely a negative month for global markets. I think off the top of my head, I don't think there was a single index that finished the month in positive territory for October. Consider this year has been pretty much one-way traffic in terms of market moving up on a month-to-month basis. So there was the market was due some type of consolidation, and we did see that throughout October. Again, looking at those major indices, these are all in their respective base currencies. So things in euros and pounds and things like that are shown in euros and pounds. We will look at the US dollar version shortly. But S&P down 0.9%. The DAX down 1.3%, which is the German index. The FTSE, which is the UK, down 1.4%. NASDAQ down 0.8%. both Chinese indexes down 1.7 and 3.9 respectively. You can actually see that China is that blue line. So they started off the month very, very strong, but there was a little bit of disappointment around some of the stimulus packages announced. And we saw those gains pared back a bit towards the middle of the month. The ASX 200, which is the Australian stock exchange, down 1.3%, and the Russell 1000, which is a broader S&P 500, so it's the next 500 largest shares, down 0.7%. Making my way to the next chart. The next chart looks at everything in US dollars as a reference or a base currency. You can see there that the DAX in euros down 4%, the FTSE down 5.5%, Australia down 6.8%. And really what that's talking to there is widespread dollar strengthening throughout the course of October. And I think that's largely in line with the market starting to position itself for the elections that happened on the 5th of November. So we did see a lot of dollar strength throughout the month. Looking at a year-to-date view, things get slightly more interesting. Again, this is in base currency first. We've got the S&P 500 up 21% in dollars. We've got the DAX up 13.9% in euros, FTSE up 8.3% in pounds, Nasdaq up 19%. China, the two respective indexes, they're up 10 and up 25. You can see that massive 25% coming throughout September. We spoke about that last month where we saw that meteoric rise, but some of those gains pared back a bit. It has picked up a little bit over November as well. There was some more stimulus measures announced, but we'll see what happens there with regards to the sustainability of those policies. Australia up 10.9% and the Russell 1000 up 20%. Russell has been a good performer of late. It's caught up to both the Nasdaq and the S&P quite nicely. There was a time up until kind of July, you can see it in the chart there, where it was trailing. So we've seen a lot of return come back into the Russell, which is good to see. I've spoken about it a few times, but it's always good to see everyone pulling their weight in an index when it comes to returns. So this year has largely been driven by the Magnificent Seven, but we're starting to see more widespread returns in the indexes. So some of the other names getting involved in the returns, which is good to see. It indicates good health in the market. Looking at our indices in US dollar terms, again, you can see the DAX up 11.9, FTSE up 9.2, and then you've got the ASX, which is Australia, like I said, up 6.4%. Looking at the next slide, our asset class returns. This is always an interesting one, and we kind of look at the leaderboard here. Far right shows the current month, so looking at October 2024, and the second last from the right, our year to date. So we can clearly see there that on a year to date view, growth assets still largely in charge there. That is your technology names. Developed market equities at 16.9, value shares at 14.5. Emerging markets picking up nicely to 12.2%, despite a bit of a pullback throughout October. That's largely as a result of the strong returns from China over the last couple of months. Small caps at 8.4% on a year to date, pulling back slightly during the month. The reason for that is just a bit of a clouded outlook around growth and interest rates. That seemed to be the dominant theme throughout October. They have since jumped up very aggressively throughout November on the announcement of the Trump victory. Global REITs, which is your real estate investment trusts, up 7.7% for the year. They were the biggest loser throughout October. Again, interest rate sensitive sector and adjusting to a potentially clouded outlook around rates. Commodities at 3.9 for the year, and global aggregate, which is the global bond market, at 0.1 for the year, also coming under pressure in October as a result of interest rates. Alrighty, so what happened during the month? October was a volatile month for markets, with equities moving lower after a strong rally during the first 9 months of the year. Like I said, I think this was the second negative month this year. So I mean, consider out of 10 months, you've only had 2 negative months, which is quite remarkable. Growth risks remained the primary concern for investors, despite signs of resilience, particularly in the US economy. Uncertainty was also heightened by the upcoming US election and the potential implications of a policy shift on inflation and interest rates. So in the US, we saw inflation easing by less than expected. So there was an anticipation that inflation would come down a little bit more, but it didn't. Headline consumer price inflation in the US is currently at 2.4%, with core inflation that excludes food and energy remaining elevated at 3.3%. That was driven by rising costs in medical care, auto insurance, and airline fares. Just as a note, we do have inflation out of the US this evening, so it will be interesting to see what those numbers print at. Following the Fed's
What's your expectation there as of interest?
I think largely the same. To be honest, I don't think we're going to see anything major there. What will be interesting is just to see the kind of guidance around that, and if there is any Fed speak, and just to understand their thinking. I will touch on it now shortly, but there was a 25 basis point cut on the Thursday following the election. So we have seen further interest rate cuts, but again, the guidance was a little bit more hawkish, meaning that it was a little less quantitative easing speak than we've seen in the past. And the reason for that is that the Republicans are typically viewed as pro-growth, but with that comes potential inflation concerns, A, and B, a potential for higher for longer interest rates. So the Fed is they're not in a pickle. I wouldn't say that, but the likelihood of slightly elevated interest rates based off previous estimates of the neutral rate are likely. So again, just to give you context to that, prior to the election, the neutral rate for US interest rates was expected to settle at around 3.5%. They're now talking about the potential for it sitting closer to 4%. So in other words, 50 basis points worth of cuts potentially off the table to combat what might be a higher inflation environment as a result of Republican policy, in particular corporate tax cuts and things like that. So they're expecting those tax cuts to come through. They're expecting corporates to generate better earnings, and they're expecting more liquidity as a result of that, and that in turn driving up prices, which can create a bit of an inflation problem. So I think we'll definitely see a more wait and see approach out of the Federal Reserve, which I've actually got a picture shortly that talks to that. That talks to the market's current thinking around what the next interest rate cut, if there is one, will look like. Right, I'm going to jump across to Europe. So in Europe, inflation largely seems to be under control. However, the European Central Bank, the ECB, has acknowledged signs of weakening economic momentum, particularly in the manufacturing sector. Consequently, the ECB the ECB announced a third interest rate cut of 25 basis points, taking their deposit facility rate down to 3.25%. This was largely in line with expectations and highlights the relatively more predictable path of European rate cuts relative to the US. So the Eurozone knows exactly what they need to do. They need to stimulate growth. Growth there has been weakening quite a bit of late. Their reliance on China has somewhat been exposed in the last couple of months with China slowing down quite aggressively. So they know that they need to cut rates to stimulate growth. Equities in Europe have been struggling as a result of that. Something I'll also talk to on the next slide. But interesting to see another rate cut coming through there, and the acknowledgement that they need to cut rates. They are in a much more dovish environment, or the Fed speak is a lot more dovish, meaning that they acknowledge that they need to cut rates and they need to ease to stimulate growth. It's become very obvious in the Eurozone. In the UK, the labour market remains tight with unemployment at 4%, and pay growth still high at 4.9% year on year. So they've got majority of people, they are employed and they are earning well, and those earnings are growing on an annual basis quite aggressively. But despite this, inflation seems to be largely under control, with the headline inflation printing at 1.7%. and core inflation coming in at 3.2%. So the UK seems to slowly be figuring things out again. They will need to cut as well to stimulate some kind of growth there. In China, recent support measures have renewed focus on the country's equity market. Policymakers introduced new initiatives which will allow local governments to use special local government bonds to purchase land from troubled developers, alongside a planned debt ceiling hike for local government. So again, China's been in a bit of a lull for the last 18 months. Authorities there are trying to come up and initiate policies that will help spur some growth. Chinese residents are holding on to their cash, they're not spending, and as a result, growth is starting to decline in China. So policy makers, they're doing their best to try and spur some kind of growth. Markets, as we saw in the charts on the year to date, initially reacted very positively to the news. And then there were some slight adjustments to what that policy actually looked like, and we saw some pairing of gains. But ultimately, equity markets getting a bit of boost. The focus now will shift to the sustainability of that equity market run and the sustainability of those policy measures. So it's all very well that it's been announced, but we need to see it actually making a material difference in the market going forward. Alrighty, jumping on to just some charts that I found interesting, or some reading that I found interesting throughout the month. I'm going to read this top left to bottom left, top right to bottom right. Don't ask me why I pasted it that way, but I'm going to roll with it. Top left is an interesting chart. It looks at the betting market odds and Bitcoin spot ETF inflows. I know some of you guys like your crypto, so you might find this quite interesting. And really it shows a high correlation, or a tight correlation, between the likelihood of a Trump victory leading up to the elections relative to Bitcoin ETF demand or inflows into the crypto space. So again, you can see that high correlation or tight correlation there throughout the period. Obviously, post the election outcome, crypto has gone absolutely nuts. So you will see, if one were to update that chart as at today, you would see a massive spike to the upside, which is interesting. Obviously, Trump leading up to the election has been quite vocal around his stance on crypto and deregularization and things like that. So just interesting to see how that actually plays out. The bottom left chart, one that you'll be familiar with, I've shared before. This really just talks to the outlook on interest rates. At the moment, we're in that middle band at 450 to 475, so 4.5% to 4.75%. And the percentages is the probability assigned by the market of staying at the current levels or cutting a further 25 basis points. So as you'll recall in the past, I mean, we are still 36 days out from the next Federal Reserve meeting. But just interesting to note here, the market, their current positioning or their mood towards interest rates, it's not as clear cut as it once was. I mean, we've looked at these before where it's like 99.9% certainty that there is going to be a rate cut. So just seeing a little bit of divergence there, and I think it just talks to what I was saying earlier around the job that the Fed has on their hands now, with regards to the new Republican Party and what that might mean for inflation going forward. So just something that we're keeping an eye on. Top right, another interesting chart, and I think this talks to a lot of the growth metrics and things that we've seen out of the Eurozone relative to the US, and as a result of that, share price behavior or reactions. It looks at the divergence, or how high the divergence is between personal savings in the US versus the UK, or not really the UK, sorry, the Eurozone. But the growth gap that you're seeing there, so you can see high savings in the Eurozone relative to almost half that in the US, meaning that the US are spending a lot more aggressively than people in the Eurozone. But you're seeing that growth gap as a result of divergent consumption patterns due to wealth and sentiment differences, right? So the US spending is fueled by growing wealth and confidence. The GDP now in the US is expected to push even higher as a result of the Trump victory. So I think previous numbers were at around 2.5% for 2025. That's pushed up to around 3% as a result of the Trump victory. But just interesting to note there, and I mean, you can obviously see it in share price appreciation and their earnings as we get towards the end of Q3 earnings. US companies have done well, whereas those in the Eurozone have struggled. And I think that's largely a result of sentiment of the actual consumer and their spending habits. So interesting to note that divergence. Lastly, bottom right, this talks to the earnings season, and it looks at the market reaction relative in the US relative to Europe. We can see there that outperformance in the US has been highly rewarded, whereas in Europe, underperformance is being punished. So in other words, earnings surprises to the upside being highly rewarded in the US, and earnings surprises to the downside in the Eurozone being punished. And you can see that relative to past history. You can see it's outsized, right? You can see big punishment there on the downside, and big reward on the upside. So again, I think that talks to sentiment, that talks to the market's mood towards the Eurozone relative to the US. A lot of the European companies at the moment are pointing fingers at China for their weak results. And again, like I said earlier, the last couple of months has exposed Europe's reliance on China from a growth point of view. So again, interesting just to keep an eye on that. Yeah, that's me, Scott, on the commentary front.
If anyone's got any questions, please just type them in, because obviously we're in a very interesting period with what's happening with Bitcoin, and obviously the elections last week and everything else. I mean, you kind of spoken already to it, but in simple terms, and it's always hard to ask this question without kind of starting a whole political debate. But I mean, in simple terms, the market sentiment is showing that a Republican victory is kind of good for business. Is that what you would say, basically?
Yeah, so there's been a divergence. It's been, for now, I mean, consider that we're only a couple of days into this, and there's still, I would argue that we're still in a bit of a honeymoon period. But I mean, Republicans are viewed as good for business, and ultimately that's good for equity markets. Bond market has sold off So yields are pushing in the US, pushing around 4.3%, up from around 3.94. So bond markets have taken a bit of a beating, and all other currencies have taken a bit of a knock. So in other words, they're viewed as good for equity markets. They're viewed as bad for bond markets because you've got increased inflation and the potential for increased interest rates. So a bit of a double-edged sword there. I wouldn't categorize it as good for the whole market, but I would certainly say good for equity markets.
Okay, and then Sharon's actually asked a question, which was going to be my second question, is that my understanding is that like a Republican, I'm just going to say Republican to keep it like to keep the sentiment, like because I brought up someone's name at a panel yesterday and I nearly got shot for talking about Trump. But anyway, so let's just call it Republican. So, but what Sharon's asking, I think, is also relevant is what will be the impact on kind of global trade with this whole America First kind of principle. So what Sharon said here is there any way to know what effect higher tariffs will have?
Global trade is an interesting one. I think potential for de-globalization has been a bit of a theme building up to this. And what I mean by that is, I mean, the last 10, 20 years, there was a big push for globalization, having your product developed elsewhere around the globe and getting cheaper costs and things like that. Trump's agenda, or the Republican agenda, seems quite clear in that they want to try and bring trade and those kind of things back into the US. And that's what the Fed's concerned about, because there's just no way that the US can compete on prices for their costs of goods like some of the other countries in the world can. And ultimately they're seeing that as potentially problematic for inflation. Hence they've got this bit of a tricky way forward on how to deal with all of this. But I think it means, I mean, again, we'll need to see what policies get implemented, things like that. We've still got the House of Representatives outstanding. So the Republicans have won the presidency and they've also won the Senate. They haven't won the House of Representatives yet. If and when they do win the House of Representatives, I say when because it's looking very, very clear. I think they need one more seat for a majority. But ultimately, then that kind of wraps up a clean sweep, meaning that they would have won the House, the Senate, as well as the presidency, which also means that in the future, any kind of policy changes can go largely uncontested, because you've got a majority across all the necessary voting points along the way. And again, I think if that happens, you will see global trade slowing a bit potentially. Yeah.
Okay. Nozipa said, what do you think they will do with AGOA for Africa?
Yeah, good question. I did see that creeping back onto the radar. I saw that the GNU wasn't over the moon around some of the outspoken comments around Russia and things like that. So I don't think it's going to be a priority for the Republicans at first. I think they've got bigger fish to fry initially, but later in the term it could creep back onto the radar. And I think we'll need to play our cards right there, and just make sure that we're not viewed as kind of aligning to Russia and things like that. So I think it's going to be interesting. I don't know the answer to that outright, but I do think it's going to come into the spotlight at some point.
Another question from my side, one of the things I always enjoy with Clem Santa is where he kind of gives us the flags and the kind of so he gives us the scenarios, the flags, and then he kind of gives us probabilities and milestones. So if you were to take the next, because I know it's sort of, it takes like 100 days for the president to get into power and all that sort of stuff. What are the kind of the important things? So one of them would be this House of Representatives. What are the important things that we would need to look out for over the next, call it 3 months, in terms of this transition, if flags, if you want to call them?
Yeah. So interesting question. Transition will only really take place early next year. So they do the elections now, but the transition period, there's still, if I'm not mistaken, a couple of months left of the existing 4-year term until we start to see that handover process. I think firstly would be the results of the House of Representatives. That's still a bit of a, I wouldn't call it a wild card because the market has already made it very clear and have positioned for the House being won by the Republicans. That's where we saw some of the equity market performance come from. What I would look out for if there is any upset in that, if we start to see a late Democrat victory or something like that, that would have a material impact on markets. And then I would just be looking to understand the transition process and how that unfolds. I think historically it's been quite good. There hasn't really been any major upsets. I would look at or understand the rhetoric by the Republicans towards countries that are currently in war. So the Middle East as well as Russia and Ukraine. Again, I think if anything can come from this Republican presidency in the initial months, it would be some kind of resolve, hopefully, around those countries in war. So I think Trump has made it very clear that he's not supporting any kind of wars. So if he can get countries to the negotiating table or apply some pressure on either side for them to come up with some kind of resolve, that will be good to see, and I think you'll see markets celebrating something like that.
Awesome. Okay. Well, if anyone has any other questions, I know that we've still got more from Anthony today, which I'm excited about. And I've got a quick surprise to share with you before we go there. And what we always do, and it's I don't know if you know this actually, Anthony, but last month was our 2nd year birthday. So you and I and Alex and the team have been doing the Mastermind now for a full 2 years. And what we always do at the end of the year in the December is where we kind of review 2024, the year behind, and we kind of start to look forward to the year 2025. And I suppose a number of these things we're talking about I think next month's going to be a crazy update in terms of what's happening with Bitcoin and everything between, but it'll also be interesting to be pivoting into the year. So what I want to do now is I want to share with you something really exciting. So we've been working on this with the Calio team for the best part of at least 6 months. We did soft launch it at the Wealth Weekend, and I'm super excited to say that we pretty much are there now in terms of sharing with you an entire system to make your lives easier. So when you go to the deals, and this is the point where we would normally in this update go into the deals and actually go through the deals, but I've agreed with Glenn that today I wanted to take you through the process in terms of where we're at. So just a reminder that when you go to the deals, you can literally go to wealthmigrate.com. There's 4 simple steps. You can sign up, complete your profile, fund your wallet, and invest, and you can get started literally from $10. So the minimum investment is $10. And then for those of you that want to use the private wealth global platform, it's the exact same functionality, same login, same wallet, everything. However, this is where the Calio private equity deals are also put, but there's a discount, a 50% discount on the fees in terms of the process. And effectively, it's at this level that you get the minimum investment here is $50,000. So you've got $10 on the Wealth Migrate platform, you've got $50,000 on the Private Wealth Global platform, which is the deal. However, what I want to share with you today is something that I'm super excited about. So we've worked on this for a long time to make the whole user experience that much better for you in terms of the process. And again, it's our partnership between the Calio team and ourselves, and it's all about getting you results safely and simply. So if you look at our exclusive learning and community platform, we've got the learning platform, we've got the calendar events, we've got the accountability, we've got the community engagement, and we've got the interactive community-based learning. So let's just go to this quickly as I take you through the whole process. So let me go through. So hopefully you all are now on school. So let's just start off with school. And if I go to the school group, and if I go to just how you would see it if you log in, you can literally see here's the community. You can go in, you can write, you can talk to people, you can ask questions, you can engage with each other in terms of the entire process. The couple of things that are important. If you go to Classroom, which is up the top here, And you literally, if you go to start here, okay, and I'm going to take you through the process, you can see the monthly recordings. They're here every single month. We put the monthly recordings here. If you want Wealth Going Global, it's here. So you've got access to Wealth Going Global. You've also got access to Asset Mastery, and you've got access to the recordings of the Wealth Weekend. So everything's all in one place. But in simple terms, and the last thing last two things I want to share with you. One is you can go to the calendar. So you can literally go into the calendar and you can see when anything is happening. So as an example, the session that's happening right now, you no longer have to be worrying about WhatsApp or anything. You can literally click on something. You can read all about it. You've got access to the Zoom loop. You can add it to your calendar. Literally everything's here. And what I promised you, and I try and do this every year, if you literally go through every single month, you can see we do it earlier next month because I know a lot of people are going on holiday, but you can see the January time, you can see February, you can see March, they're all there. So it's the middle Wednesday of every month, and you can go right through to December next year in terms of the calendar, and everything's here. All the different sessions are in the diary. You've basically got them. And then the part that I'm excited about is if you go to the classroom and you can literally go to start here. As you know, we've got the 9 steps. So the 9 steps to generational wealth. And just to remind you, I do have a PowerPoint here in terms of this process. So we've got the 9 steps to generational wealth. And if I just remind you that the focus is globally diversified passive income and portfolio growth. How do we do it? Well, we diversify across countries, currencies, assets, partners, and time. And then what do? Well, we take the long-term goal and we break it down into mid-goals, sub-goals, which effectively we do monthly. And then we got the tasks and activities. And then the 9 steps, this is what we take you through in terms of the 9 steps. So you can see that phase 1 is the setup, phase 2 is planning, and phase 3 is about results. And we literally take you through each one of these steps in a systematic way. So phase 1 is where you sit with me one-to-one and you get very clear on your top 3 outcomes, your top 3 priorities, and your top 3 measures. Phase 2 is where you sit with Alex and you get set up on the investment platforms and get ready to actually, take action. Phase 3 is where you sit with and get very clear on the Enneagram and wealth. So you get very clear on who you are as an investor, so that this helps Anthony and the team help you make better decisions because you understand yourself better. Then you go to the planning phase. You sit down with the family office team around your portfolio health check. What are your current assets? Where are the overlaps? What do you need to know? Then it's about portfolio optimization. How do we actually optimize what you've got, protect your assets, and build a plan? And then you got your wealth, your lifestyle, and your legacy plan. So that's your overall plan. Now, a lot of people in life have a plan, but they don't execute. So phase 3 is all about results. So every month we check in with accountability, mindset, and execution. We have the session we're having right now, which is the community, the partners, and the knowledge transfer. And then ultimately, you've got the investments and results. So those are the 9 steps. And what we've done for you is we've hopefully made it really easy. So you literally you get started here, like literally click on the very thing, welcome, watch, and read first. And there's a video on how it works. There's some guidelines, and you can literally go in and, introduce yourself to the community if you're new. If you want to get set up, a lot of what I'm showing with you already might be repeated here, but again, there's a video. It literally teaches you how to get set up. You've got the 9 steps, and you've got an explanation between the 6K club, the 12K club, and the 24K club, and the breakdown. And every time you can see down the bottom here, there's links. So you can go and click why masterminds get results and how, and the coaching agreement, etc. But it's all explained. Every single step is explained in this video. Then you go to establish the vision. And again, you've got the video, how it works, and you've got your outcomes. And then you've even got a button here to click here to literally write them down. So you literally can see that everything is made simple for you. It goes straight to the sheet. You don't have to save sheets. You don't have to know anything. And it's literally there. And there your top 3 outcomes are, your top 3 priorities and top 3 measures. So from your very first session, you go and write them down so that they're there. Then you go to your investment solution setup. And again, what are the top 3 action items? And you literally go and book your session. You can literally, with Calendly, no more emails, no more WhatsApps, go and book your session directly. Then you go to your investor profile. Again, it explains how it works. And by the way, we're meeting with the Calio team tomorrow afternoon at 3:30, because this we're wanting to integrate where literally you can do the test, you can click on a link, and you can book your session with Corin or Bianca directly using it. Then you go to your portfolio health check, and this is something that we're wanting to set up with Anthony as well, where there's a number of steps here. You would fill in your investor survey, and then you would go and book your session. So again, people are in complete control. This still has to happen. At the moment, it's been manual with Alex and our team managing between their teams, but it's going to be completely automated in terms of the process. Then you go to portfolio optimization. And this is where, again, there's a video that explains exactly how this is. So each one of the 9 steps has a short video, literally 1:57. It explains exactly what each step is, how it works, and what you do. Then you've got number 6, the wealth and lifestyle legacy. You've literally got the entire process. Then this is number 7, the accountability and the mindset. So again, you've got the video that's here. It literally tells you what to do. There's a short video on how to fill in the monthly accountability sheet. So if you're not aware, I'm not going to go and repeat it all. But again, I do want to just point out for you something that's really important now. If you go to this pyramid on the right-hand side, you'll see that you've got your long-term goals. Then you've got your sub-goals, which are your monthly, what you say you're going to do monthly. And then you've got your daily, tasks and activities. So if you break that down, and if we go back to here, you can basically see that you've got your long-term goals. So what are your top 3 outcomes, top 3 priorities, top 3 measures? You can see in blue your long-term goals. Then you've got your sub-goals. What do you say you're going to do each month? So what is the one action that you're going to take for this outcome to move this outcome forward? Okay, so what's the one action? And then, and every month you grade yourself as to whether you did it or didn't, and what's your action for next month to move it forward. And then you've got your tasking activities, which are some of your highlights for the month, some of your challenges, if you've got any questions and any key learnings. It's a very simple process to emulate this. What is your long-term goal, which we should be checking every month? We should just be reading it. Are we on track? Are we off track? What are our sub-goals? What are we basically going to do every month to move towards our long-term goal? And then what are our daily activities in terms of that process? And literally everything is here in the school group. So you can go in, you can put your diary, dates in here. You can got the link to the monthly accountability sheet. You've got how to use the accountability sheet. There's a video here on what is the difference between the 6K club and the 12K club. And in simple terms, the 6K club is where we do the group coaching. So each person has an opportunity within the group coaching environment. And the 12K club is where we sit in a one-to-one environment. So I work with someone one-to-one, and actually we sit down and we say, right, what is your goal? What is your measure? And then every month we review the month. We give ourselves a grading for each one of the 3 outcomes, and we get very clear for the next month on what the clear focuses are. And again, there's a video that can explain that in more detail if you're interested. You've got the weekly planning schedule, which is the tool I've given you on how to do time management. You've got the 60-day challenge. So everything is there to help make it easy for you. Then you've got the community. So again, this is the community sessions. Again, a short video on how this all works. And again, you've got the link to the calendar and the monthly recordings. And then finally, you've got the investments and the results. And again, there's a video here. You've got your action items. And then you've got the link directly to the Wealth Migrate platform or to the Private Wealth Global platform. Again, just to be clear, the Wealth Migrate platform, the minimum investment is $10. The Private Wealth Global platform, the minimum investment is $50,000. And there's a different fee structure between the two. And then if you need to book a meeting with Alex, you can literally go and do it. And then lastly, if you want to add value, and I'm a big believer in Zig Ziglar's principle, you can have anything you want in life if you help enough other people get what they want. So, share the love and invite a friend. So our logic is always, the chances are that we're looking to build like-minded people in the community. So the chances are if there's someone else that you think would get value out of this, either use our affiliate program or literally just let Alex or I know and we can help you do it. And there's a breakdown of how our kind of affiliate program and stuff works. So that, ladies and gentlemen, is that. I mean, literally everything is here now. I'd like to think that we have made it super easy for you. It's all in one place. All the links are in one place. There's literally only one place that you need for the entire mastermind between ourselves, Calio, and everything in between. Because if you click here, you've got links to all the different parts of the process. It makes it really easy. You've got the community that you can go and engage and ask any questions with in terms of where you're at. And I mean, there's even fast links over here between Start Here, the calendar, and the investment platform. So again, that's really easy. I remind you that the calendar's here. So there's no more, I don't know when stuff's happening, whatever. Everything's in the calendar. Anything that's important will be in the calendar. Your fellow members are here. You can literally go and talk to any one of your members if you're wanting to interact or relate to them. And then, most importantly, you've got the classroom. And this is where you always go in terms of your 9 steps, your monthly recording, and the different important stuff. So I'm going to stop sharing quickly. And I wanted to ask Alex or Shane if there was anything I was forgetting, because this has taken an extraordinary amount of work and effort to put it all in. And by the way, it's never completely finished. So Shane's even burrowing behind the scenes to take what we've got on the Google Sheet and make it an even more integrated experience. But we very systematically tried to simplify things, as an example, just with the Google Sheet, and literally take that mindset of the pyramid and say, right, you got your outcome, you got your monthly measures, you got your daily tasks and activities, so that everything's in one place, completely simple, completely clean, because simplicity is power, and it's the power that'll get you the results. Alex, I can see, as always, you are begging to speak. Anything you want to add with regards to that process?
Scott, you know me too well. I think just one or two things that I think is important here. I think you've covered 99.99% of everything, but a couple of people have been asking me, so they're very excited. They want to make sure that they're planning their 2025 successfully. Like, when are we going to have another wealth weekend? Are we doing buyers trips? When are we going to get together in person in the different cities and, globally, and so on and so forth. And effectively, what we're going to be doing over the next 2 to 3 weeks is plan out the entire 2025. So our wealth weekends will be in the diaries there, when we're planning to do events, wherever, in which cities are going to be there. So it's literally a one-stop shop for Mastermind members, so that you don't have to go and try and figure out or message me or email or anything like that. It'll all be in that calendar for you. So it makes things very, very simple. So that's one thing. And then I think the only second other thing is that we're also going to be doing a lot of value adds in terms of snippets where Anthony spoke about the market. So we're going to cut out that part, and we're actually going to say, okay, here's January, here's February, here's March, et cetera, et cetera. So if you only want to watch the market updates for the different different months and so on and so forth, we'll have that with the presentation so that you can just easily access that, all in the course's point of view. And I think the only thing that I would ask is, if anyone is not on school, please do go on to school. Reach out to me if you haven't been able to get access, or if you've tried getting, setting up a profile. Let's just get you onboarded, because then I know that everyone's there, so that we're all in one, we're all systemized in one way. And then if there's something that we're missing, just let me know, because we've probably spent about over 200 hours on this to try and get the 9 steps right, to try and get the integrations right, and so on and so forth. So, but as Scott said, we're always trying to kind of find that 20% to make it better. So let me know if there's anything that we should be adding, or if we're oblivious to something, because we, again, work with these things every single day of our lives. I just want to say, Scott, I know it's been a lot of work, so just wanted to acknowledge you and Shane and everyone on this call, because we've done it on by a community, and it's been quite a lot of fun, and getting insights from all of our mastermind members. I know that I've had many meetings with a lot of people, and I've heard your frustration, and hopefully we've now articulated in a good way. So just quite happy that we're here now.
Yeah. And as Alex is sort of alluding, every step has a video. So that's why I'm not going to repeat it now, because your time is valuable, and I'd much rather pivot to Anthony now. But you can literally go in every step. You can watch the video, how it works, what the tasks are, literally what the action items are. And every single page, just to repeat, just in case it wasn't clear, every single page always has the kind of the action items down below. So if you go to any one of them, portfolio health check, literally there are the action items. And if you need to click on an investor survey or anything, it's the resources are always below. So literally, it's super simple. Everything's in one place to make it really easy for you in terms of what is happening through this whole process. Shane, anything from your side in terms of where we're at?
Yeah, thanks, Scott. Nothing from my end.
Awesome. As always, Shane loves the public arena. So, but Shane's been amazing. Without building all the systems, we wouldn't have been able to build this. So I deeply appreciate it, Shane. What I learned with Roger Hamilton, and credit where it's due, I worked on his mastermind. And by the way, that cost me $25,000 a year. And we did it on a Google Sheet. And it's always blown me away that it worked so effectively on a Google Sheet. And yet it's been such a problem for everyone on our Google Sheet. But anyway, we've now built an entire system using pretty much the best of out there, but putting it all within the school environment. And by the way, school you can do it on your desktop, you can do it on an app on your phone. So literally everything's all in one place in terms of it. And just in case people get confused, our mastermind is called Private Wealth Global, but it operates on School. So School is like just a technology platform. And so if you get confused, like School's just the technology platform, Private Wealth Global is our mastermind that we're working on it. So yeah, Archie, thanks very much. It has been a lot of work. And yes, the intention is I am still coming to the UK the first week of December. I'm talking to Paul O'Mahony. I thought it was today, but I see he's moved it to tomorrow. The event we're looking to do is the 4th and 5th of December, but I still just need to confirm that with him. Angie, thank you for the kind words. Glenda, also thank you for the kind words. Nozipo, and Shane says no time to talk, busy building systems. So I think that emulates it perfectly from Shane's side. And I think, Anthony, I'm glad you watched this as well, because now I know Anthony's been trying to pull Calio into the digital 21st century for the whole time he's been there. But this is that moment, Anthony, where we now want to really kind of integrate calendars and make all this stuff really kind of, because but behind the scenes, Alex and the team have been emailing back and forth and all that stuff. And we just want to keep systemizing each step of the way. So I know that all the integrations are not there yet, but hopefully now everyone can see the framework of what we launched. What's it called when you preliminary launch something in a beta version at the Wealth Weekend, and now we actually have the system to work from where we can all operate. So it's nearly time to pivot to Anthony. I just want to share a couple of last things before I do. So let me go to here. So last month we did the question around, do you want to be a global citizen? And it was all around, I love this little picture of a passport of a global citizen. And again, Garth did a great session. Garth and Anthony did a great session on tax and structuring. So a lot of people have asked us about that. Remember that the recording will be there. So again, this is one of those classic examples where you literally go into the classroom, you go into monthly recordings, and you can literally go through and see where the recordings are. And by the way, guys, we need to we need to put the October recording in there. But anyway, it would automatically be there. So you've got access to the recordings in terms of that process. The other thing that I did last month was there's a recording, but ultimately it's where tech meets investment, real estate, and wealth. And again, I'm going to talk about this tonight in the fireside chat. It's something that I'm deeply passionate about. I've literally invested my entire career in this. I've been doing this for 28 years on how technology is going to change the space. And it's a significant opportunity. And as Ilda and others have alluded, it's also a way to participate, if you like what we're doing, to actually become, I know Ross and others as well, have actually participate and become a shareholder in our company in terms of it. And then one thing that I wanted to share, which I'm super excited, and I wanted to congratulate our mastermind members. We launched a couple of brands, businesses effectively over the weekend. So we launched Women in Wealth with Judy and her team. We had an incredible lunch with 7 of the mastermind members, ladies, on last Thursday. And what literally launched on the weekend is so we still got to work on the landing page, etc. It's nowhere near finished, but effectively we've got the landing page, started now, and we've got the entire investment platform for Women in Wealth. So the dream has finally become a reality in terms of that whole process. So to the ladies in the room, We've got a WhatsApp group for Women in Wealth, and I'd strongly recommend that you get on board and help support that movement. Then for Farmers in Wealth, Derek has taken this forward. And again, we've literally launched this on the weekend. So we've got Farmers in Wealth, and literally, again, we've got an entire platform just for farmers in terms of that process. And then Abdul, we've also launched Business Owners in Wealth, and we've got an entire platform for business owners and entrepreneurs. And again, with the focus on them and their investments, etc. And then next year, a whole bunch of people continue to complain about being able to help, like Kathy said, being able to help her 20-year-old daughters or sons, in her case, her daughters, but for other people, sons. And Alex is in the process of putting Millennials in Wealth together so that we can actually launch that. And the whole intention is to get that live by next year. So if those are things that interest you, I know that Garth Milne is doing Golfers in Wealth. So we've got some really exciting partnerships that are evolving, and I'll ask you to get involved. And without further ado, now it is time to pivot to Anthony. And this is a really, really interesting concept. We did this previously. We did this in October last year. It was the first time that Anthony did it. And to give you the backstory behind it, was I was sitting with Anthony and Garth. They were talking about asset allocation, and they said something really pivotal. They said 85% of your total returns are going to come down to your portfolio construction. And again, a lot of us just assume these things. We say to ourselves, okay, well, I know what Anthony means. And when I actually kind of asked the questions, I said, what does portfolio construction actually mean? And Anthony said, no, well, there's 6 pillars to, portfolio construction. And so back in October last year, Anthony actually shared with our mastermind community what are those 6 pillars to portfolio construction. And then when we did the Wealth Weekend in, when was it now? March. We actually spent the entire weekend just going into each one of these 6 pillars. So I want to be very clear. This is a topic that we could spend 1 hour on, we could spend 10 hours on, or we could spend 10 days on, in terms of the process. And I think, Anthony, when I reached out to you and just getting feedback from a number of the mastermind members, this is one of those moments where, to some extent, if you've seen this, then repetition is the mother of skill, because effectively it's a 1-year upgrade. If you haven't seen it, it's an invaluable pillars and foundations that you need to know. And I think there's 2 things that I would ask people to really be looking at. One is, what does this mean to me? And do I have my pillars in place? And if not, what do I need to do? If you've already heard the talk. And if you haven't, then it's a case of, well, what do I need to know? And it gives you a much better idea of how we work with our family office to help you set you up for success. And then I think there's one third component that I just said to Anthony, because I know you always like flippantly throw it out there with the buckets. And it was the people that only got the Wealth Weekend that got the whole bucket thing. So for the mastermind members, I want to go a little bit deeper around what are those 6 pillars and how do you use your buckets, etc. But it's without further ado that I'm deeply excited to go back to you, Anthony, because I know what you're about to share is literally the foundations. I love metaphors of buildings. And if you're going to build a tall foundation, you have to have a strong foundation. And, why we keep repeating this is because it's the strength of your foundation which is going to help build your building,
100%. Thank you, Scott. I think that was a great introduction. Can I go now? You basically summarized the whole thing.
You're all good, dude. That's over to you. I'm going to switch my camera off because it's all about you now.
100%. Okay, I'm going to share my screen again. I've made some updates to these slides actually as we kind of incorporate new things into the process. So there are 1 or 2 new parts of it, but ultimately what we're dealing with here, as Scott said, is portfolio construction and the fundamentals which get you 85% of your returns. In the presentation, I will touch on 6 key pillars. Firstly, one's time horizon. Secondly, the risk tolerance. One's asset allocation, diversification, personal outcomes / goals, and then the monitoring, measuring, and rebalancing. The chart at the bottom, the multifaceted approach, is something I'll touch on now. It ultimately relies on 3 pillars to build that portfolio construction, of which these 6 topics slot in. But ultimately, you've got your Enneagram profile, you've got your asset liability modeling, and your individual circumstances. Those come together to form the portfolio construction. Today, I'll touch on the asset liability model side of things, as well as the individual circumstances. As most of you know, the Enneagram side of it is equally as important, but I won't dive into too much detail around that. That has been handled or touched on in other webinars. And like Scott said, there are recordings and stuff as a refresher for that. When we look at time horizon, it's probably one of the key driving forces behind planning and investments, right? So you'll always hear, I mean, time is your best friend when it comes to investing. The longer your time horizon, the longer your ability to compound your capital, and the greater that sum of capital can become at a future date. When we look at the time horizon, it's important to understand our current situation relative to where we want to be. To do this, we use something called an asset liability model. As the name suggests, the asset liability model looks at your current assets relative to your liabilities or future liabilities. Typically, those future liabilities are in the form of income requirements, or income drawdowns that you will need to take at retirement from your portfolio. And the asset liability model is all about planning for retirement or planning for some kind of future event now. It doesn't need to be retirement. Some people are already in retirement. It can be legacy. It can be saving for certain things, which I'll touch on later. But ultimately, it's the framework or the base from which we work on to build portfolios. When we look at defining the parameters of the asset liability model, it's also important. So what I've done here is I've included snapshots around those parameters, right? So I think when I run through this, my goal is for you to understand the effect that each of these parameters have on the asset liability model. Now, I've taken a very basic example just to get the point across. Obviously, this is all unique and tailor-made to each individual. We typically find that no one client is the same. Everyone has different parameters or outcomes or goals that they're trying to achieve. So it's not a one-size-fits-all, but by understanding the different parameters, you get a much better understanding of how this works and what it relies on. So firstly, we look at the current age. In this example, we've assumed Joe Soap is 45 years old. They plan to retire around 65, and they have protected years of 35. Protected years, I think current age and retirement age are very self-explanatory. Protected years is an important one because ultimately we're always looking to build sustainability in these portfolios or in your portfolio up until age 99 or age 100, right? The reason why we do that is because modern medicine has got really good, and some people are actually living to those ages. Importantly, we're always looking to take care of the breadwinner first, and make sure they've got sustainability of their capital or enough capital to see them through to those later years. And secondly, if one were to pass away prior to age 99 or age 100, then the leftover portion essentially starts to form part of your legacy or your inheritance. So those who have dependents or kids or things like that, by planning to the later years, you're naturally taking care of that bucket, right? The years of saving, in this particular example, is the difference between the retirement age and the current age. The model assumes that over those 20 years, you are in a financial position to contribute to your portfolio, or at a bare minimum, not withdraw from your portfolio. So not make physical capital withdrawals in that time period. Things like interest and dividends and stuff like that are slightly different. That's obviously an interest earned from the portfolio and can be accessed. But ultimately, you don't want to put pressure on the portfolio until such a point that you need to. And typically that point is retirement. Now, retirement can mean two things. It can be physically when you retire from employment, or it can be a point at which you start to make withdrawals from the portfolio. They don't need to be the same thing, but more importantly, it needs to be a point where the portfolio starts to come under pressure, or in other words, starts to physically make income payments. We make some other assumptions. We look at inflation. In this example, I've got inflation at 4%. I'll talk you through what that means shortly. We assume a return pre-retirement, i.e. those 20 years from age 45 up until age 65. We make an assumption there around the return. And then we also make a return assumption post-retirement. And that will be essentially from age 65 in this example up until age 99 or 100. The reason why we scale back that return and post-retirement is due to, we just try and dial back the risk profile a little bit. So maybe as an assumption, you're a pure equity investor up until you retire, and then you need to kind of take your foot off the gas a little bit because you can't have as much volatility in the portfolio or assume as much risk. So we just tend to dial it back there a little bit. Again, everyone's unique circumstances will differ. There's no one size fits all. In terms of our inflation number, inflation in the model assumes the increase in income that you derive from your portfolio on an annual basis. So in other words, each year, we assume that income amount will increase by inflation, right? The reason why we do that is to ensure that when you're drawing that income in the future, let's say 10 years down the line, you are not being eroded by the effects of inflation. So your purchasing power on that income amount is not diminishing. It's important to try and keep pace with inflation so that your purchasing power remains the same. You don't want to find yourself in a situation where you haven't taken into account inflation and 10, 20, 30 years down the road, your income amount that was sufficient today is not enough to buy you a loaf of bread. So we're always taking into account that inflation scenario as well. That will jump around on current inflation numbers, but ultimately what you're looking for there is some kind of backdated average, A, or B, an amount that for you personally makes sense. I hope that's clear. Moving to the right-hand side, again, in this assumption, we assume that Joe's soap requires an annual income of R1 million. That annual income will kick in at retirement, so at age 65. Remember, they've got 20 years until they get there, so they're in a position to save and contribute to the portfolio and not withdraw from it. We assume annual contributions, again, in this scenario, of 240,000 Rand per annum. I mean, if this isn't clear, these are all thumb-suck values, but I think the importance here is just around what effects this has over a prolonged period of time with these assumptions. And then we assume Joe Soap has a current saving balance of 3 million. That current savings balance is important because that is the capital amount that is doing the heavy lifting or is assumed to be generating some kind of return. And I think, again, in terms of portfolio construction, when we do a lot of the initial analysis work, it's understanding whether or not the current assets are in a position to generate the return assumptions, right? So we could see return assumptions scaled up or dialed back depending on what that current balance sheet looks like. So again, in this scenario, we've got 3 million. Ignore the rest for now. I'll show you how this all plays out essentially up until age 99 in the next slide. So jumping to the next slide, you'll see there's a couple of rows here, namely year, age, salary contribution, withdrawal, growth, balance, and return. So remember, we started with a capital amount of 3 million. You can see that in the top right. Joe Soap is age 45. You will notice that there is a contribution of 240,000. That contribution is also increasing each year by inflation. You will notice that there is no withdrawal. So in other words, Joe Soap is not retired. They don't need to draw capital down from the portfolio. So that withdrawal only kicks in at a future date. Again, an important characteristic there, because ultimately those 20 years leading up to retirement are the years in which you can compound and grow the portfolio up into a significant amount so that you can live off it, right? So you can draw the income down from it. The growth is the actual monetary amount each year of the return. And then we've got our return assumption on the right-hand side, that 10%. So you can see that after year one, our 3 million has a 10% return on it. So it's growing by 300,000 plus an additional contribution of 240,000 that we spoke about in our assumptions. That gives you a capital value at the end of year one of 3.5 million. And you can see very quickly after that the effects of compounding kicking in. Again, keep in mind, when we assume these kind of return assumptions, they're linear in the model, meaning that they grow on an annual basis by that exact amount. The reality of markets and investments, as we all know, are somewhat different to that. You'll have years where you do greater than that return assumption, and you'll have years where you do worse than that assumption. What we're looking for when we define our return assumptions is a long-term return that's viable. So let's say long-term equity markets are doing 10% in dollars. That becomes somewhat of a viable return if Joe Soap needs to target pure equity returns. We wouldn't go and put in there 20% because it makes the model look good. So it's important to keep some kind of realistic approach to that, and that's also fleshed out, like I said, by doing an in-depth balance sheet analysis and just understanding the current assets. Some assets won't keep pace with that. Others will generate higher returns or can potentially generate higher returns. Point being that it needs to be accurate, A, and B, it won't happen in a straight line. We're looking for that average over an extended period of time. All right, I'm going to jump to the next slide. The next slide is where it gets a little bit more interesting. As you'll notice on the left-hand side, Joe Soap has now turned 65. He's retired, and he starts to make withdrawals from his portfolio. Notice the withdrawal amount at just under 2.2 million. Originally, our assumption was that Joe Soap would take R1 million out in today's terms. That over 20 years, that R1 million has doubled. That R1 million has doubled and some. So again, that's as a result of the inflation assumption, and we do that again as a reminder, just to make sure that your purchasing power at time of retirement or at this future date is kept the same. So you can start to see there that the pressure as a result of the compounding from inflation becomes a lot higher. So again, important to have the assets in a position to be able to sustain those kind of drawdown levels going into the future. I put the balance here of 3 million just as a reminder of what it was 20 odd years ago. That's now growing to 40 million or 39 million. Again, just highlighting the benefits of time, A, and B, benefits of compounding over a prolonged period of time. In that 20-year window, you would have more than likely gone through multiple different market cycles, which I'll touch on the next slide. But again, you're looking for that average annualized return over a prolonged period of time to be in line with your earlier assumptions. You can then start to see the withdrawal and the effect that has on the capital balance. So you can see it increases to around 42.5 million at age 73 or year 29. And then you can see the effects of that increased drawdown starting to wear away at the capital base, ultimately reaching a point where if things were to play out identically to the assumptions here, Joe's soap would be running out of money between age 91 and 92. The reality of these asset liability models is they're obviously not set in stone, but it becomes a fundamental driving point or fundamental thing to understand, so that when it comes to portfolio construction, you are positioning the portfolio in such a way that it can get as close to these assumptions as possible, right? Joe's soap is not covered or not sustainable up until age 99, which means that one of the assumptions is too high or too low. Too high would be the income drawdown. So his portfolio is just actually not big enough to stomach that withdrawal. And too low would be the return assumptions. He needs to try and target a higher return because that will take some pressure off these numbers. So again, I'm not going into a return debate here around what's high and what's low and what's realistic and what's not. I'm more just trying to illustrate how the parameters have an impact. Now, I typically would try and position this differently. I would typically try and get sustainability much closer to 99. But again, this becomes a personal thing, and it becomes a personal kind of discussion around the likelihood of living to these later years, as well as if there are any dependents and things like that. So again, it's not a one size fits all. You might have something in the family that, I mean, no one's lived past 80 for argument's sake, and 92 would be considered well into the future. But I think you get the point around how this works, how the parameters are defined, and how it's still very tailored to each person's unique circumstances. Some people need much lower returns because their income drawdown relative to the size of their portfolio is small. Others require much higher. It all depends on what you're trying to achieve. Alrighty, moving on to the second pillar. It looks at one's risk tolerance. I make some notes here that it's largely driven by one's time horizon. We look at market cycles on average being between 5 to 7 years. And then we also note that personal goals here play a large role in determining the levels of risk one can take. So remember, when we say risk is largely driven by time horizon, it's because of these market cycles, right? So if you've got 10, 15, 20, 30 years until retirement, by definition, you can stomach volatility. So you can stomach the ups and downs of markets over that period of time, because you know that you will more than likely see different economic events throughout that time period. And should markets decrease significantly, take 2022 as an example, you can stomach that drawdown because you're not reliant on that capital in the near future. Right, so you can wait for 2023, 2024 for markets to recover and go back into positive territory. So it's all got to do with your savings and your investments that you allocate to. There should be some kind of time horizon associated with it, so that you can understand the level of risk you can take. If you know that in 1 year from now, you want to use X amount of money to put a deposit on a house or buy a car or anything like that, you should not be going into high risk investments or investments that need a longer time horizon to pay out, i.e. equity markets, i.e. private equity, those kind of things, because you've got an imbalance there and it's going to lead to trouble. So that's really what we're talking about there. I show a chart of a typical business cycle and stock market cycle. You can see there you've got your expansions, you've got your recessions and your recoveries. And that is the typical kind of ebbs and flows of the market. You don't want to find yourself in a position where if you need income in 2 years' time, you're investing 100% into equity markets, they experience a bear market, they drop down in value, and you're forced to pull an income from an asset that has decreased in value, right? That's kind of key here, is matching your time horizon to specific assets, and in turn using that to determine some kind of risk tolerance. Now, we are not fans of what we call risk modeling. Hence, we use the asset liability modeling. Risk modeling asks various questions around your perceived idea around how you view risk. So it asks you, do you mind volatility? Yes. Okay, well, then you must only invest in income funds. It doesn't take into account any kind of future liability or time horizons or anything like that. So I think we definitely find that the asset liability model is a more powerful tool, because we allow the life that the client wants to live to drive the investment thesis and to drive the portfolio construction. All right. The chart on the bottom right, it's quite an obvious one, but I'll touch on it. Obviously, when you're looking at your risk versus return, you'll always typically find that the higher the risk, the higher the potential return, and the lower the risk, the lower the return. So it's just important to always keep that in the back of your mind. You can't kind of want to shoot the lights out, but take no risk with it. You're always going to typically find that positive correlation between risk and return. And it's an important thing to wrap your mind around when you kind of entering this journey of investment. All right, moving on to the asset allocation. So consider where we are in the process. We've looked at the asset liability model. We've started to get a bit of a compass or a roadmap and understand what one is trying to achieve. We have an idea around what kind of returns are needed in order to make those parameters a reality. And we start to get to the more nitty-gritty construction side of things and making sure that assets are aligned to those particular objectives or return parameters, right? So the one is very reliant on the other, right? So you can't really have a scenario in which you need a return of 8%, but you just want to sit in US Treasury bonds the rest of your life, right? Because there's going to be a mismatch at some point. And that's where the asset liability modeling is used to construct portfolios, because it tries to position or tries to give the person constructing the portfolio a good idea of what they need to achieve, right? We look at that through the use of asset allocation. Like I just mentioned, this is largely driven by the parameters of the ALM. A client does not need to take any unnecessary risks if they only need a return of X%, right? A lower return. They shouldn't then be chasing high-flying, high-risk opportunities, because they're actually just putting their capital at risk for no real reason, right? They can afford to take a much lower risk profile and have much more security around that capital. The asset allocation is dependent on the time horizon of the investor. That was something that we looked at previously. You're not going to be going into high risk opportunities if you don't have the necessary time horizon to stomach the volatility that can come with it. And it can also be influenced by one's personal goals. Again, if you've got a near-term goal relative to a long-term goal, you're not going to be wanting to take as much risk on that near term as you would be comfortable taking on something that's longer term. So it's always important to have some kind of idea around the length of investment and what you're trying to achieve. To highlight this, I use three indexes here, or three different investments. I use them as a proxy almost to understand risk relative to return. The first one I use is the MSCI World. In this particular example, it is an exchange traded fund. And I use that again as a proxy for the global stock market, right? So this would represent a pure equity investment. I look to understand the return of that investment over the last 5 years on an annualized basis. This is all in US dollars, just by the way. That has a return of 12.21%. So that would be my again, I'm using the word proxy a lot, but that would be my proxy for global equity returns. That comes in at a standard deviation or risk of 17.95. So when you look at it relative to the others, which I'll dive into more detail now, you can immediately see that if we're using standard deviation as a measure of risk, that ranks high up on the risk scale, right? The next one, Bloomberg Global Aggregate, that is the global bond market. And again, I use that as a proxy for bonds. That has a return of negative 1.64. It doesn't really prove the point nicely, but unfortunately, the bond market has been in disarray for a little bit, and the annualized returns over the last 5 years are slightly negative. But you can see that step down in risk profile when you're looking at the standard deviation. So that drops to a standard deviation of 7.8%. And you can see there that you're dialing back the return profile, but with it, you're dialing back the risk profile. So you're seeing that correlation between risk and return. The last one is again, it's a treasury bond ETF. It's very short dated, so it is essentially US cash. So it aligns to US interest rates annualized over the last 5 years. That comes in at 2.3%. More importantly, for the example, you can see that risk profile is almost zero, right? And the reason for that is because it is cash. So I'm just giving you an idea around risk relative to return, and how one would step that down or step it up as needed. On the right-hand side, just a picture there on different asset classes. We've got equity, fixed income, cash equivalents, and alternatives. So we've looked at essentially equity, fixed income, and cash. Alternatives are a bit harder to model on these kind of views. Alternatives will typically house things like private equity and that kind of stuff, because it's private in nature. The data to get on it is less easy to come by. But you would typically see that probably around pure equity type risk, maybe slightly higher, maybe slightly lower, depending on the actual investment and the operator. That always plays a large role in it. And you would typically see returns there or thereabouts, again, depending on the different opportunity and the underlying asset class within alternatives. You could see some deviation on that, but it would definitely kind of push to the upper end of the scale. And again, it's all about understanding that relative to what you're trying to achieve when you're building or constructing the portfolio. That's crucial to understand in this whole process. Step number 4, we look at diversification. So we look to understand the diversifying holdings across different asset classes and sub-asset classes. Bottom left, I've got a graphic there that just looks at the main asset classes. Again, equities, bonds, alternatives, commodities, and cash equivalents. And then getting into a bit more of the specifics around the sub-asset classes. Obviously, multiple sub-asset classes. We deal with them quite a bit, or we did deal with them earlier in the commentary when we look at the sub-asset classes. But really, there's a lot to play with here when it comes to portfolio construction and making sure that one is exposed to the correct elements from a diversification point of view. We look at bonds, we look at alternatives. Like I said just now, you see your private equity and things like that starting to come into the foreground there. We look at commodities, and we look at cash and cash equivalents. So again, it's just important to understand your blend, your diversification, and your asset allocation, always relative to what you're trying to achieve, right? So again, if you need higher returns, it might not be the best play to diversify with something like bonds, right? Because you're just not going to get the numbers that you want. Alternatively, if you don't require a very high return, bonds might have the perfect place in your portfolio to help smooth volatility and generate a little bit of upside. So again, it's all about understanding the playing field and the parameters based off step one, which is the asset liability model, and then translating that through into the portfolio construction. Second note there I add is the ability to add alpha, which is outperformance above a specific benchmark. So something higher, a return higher than the benchmark, via manager selection and style allocation. So they're just highlighting the importance of making sure that sub-asset class box is ticked and diversified nicely, because you can get some outperformance from that. And typically, it can be quite an easy box to tick in the greater scheme of things is this diversification box. It's often considered in the investment world as the free lunch. So by diversifying, you can generate additional returns, or at least decrease your risk profile and still keep pace with the return that you're trying to achieve. And then lastly, I add a note there, just saying the use of active managers to shift between different styles of investing, which I'll talk about shortly. What I want to touch on now.
Anthony, sorry, mate.
Yeah.
Just considering we're part of the Diversification Mastermind, I'd love to just repeat what you just said there. Diversification is the free lunch in terms of investment terms. I just think it's quite important that I re-highlight, because often people hear important things, but they don't let it sink in. So just repeat what you said there again, and just give a little bit of essence to what you mean by that.
So some people often refer to diversification as the free lunch of investing. And most people say there's no free lunch in investing. So basically saying that by diversifying, it's something very easy to do, and one can do it very easily, and it can have a significant positive impact on one's portfolio simply by diversifying.
Awesome. Thanks, dude. Sorry for interrupting.
Cool, no stress. And I think I'll use that to kind of just talk to the chart on the right. I know a lot of people really enjoy this chart, but it really talks to diversification, and more specifically, it talks to the inclusion of alternatives or private equity as a sub-asset class under alternatives in one's portfolio. Starting on the bottom right of this chart, I don't know if you can see my cursor, but what we're looking at there is we're looking at a portfolio that's comprised of 30% bonds and 70% stocks, right? 0% private equity. The bottom axis of this chart looks at one's standard deviation / risk, and the left-hand side of the chart, y-axis, if I'm not mistaken, taking me back to varsity days here, looks at the annualized return. And at an allocation of 30% bonds, 70% stocks, you're pretty much at around 10.5% risk, but you're on the lowest return spectrum. So you're at around 8.5%. As we start to move up the chart, the inclusion to private equity grows, right? So you're starting to get to 5%, 10% private equity, 15, right up to 20% private equity. Now, at 20% private equity, you can see you actually decrease your risk or standard deviation. So that drops down to between 9 and 9.5, but your return profile has increased. So again, this talks to the free lunch around diversification and increasing your potential annualized return whilst decreasing risk. So that's an important thing to keep in mind. I would argue that you could, again, it's person specific, but we typically comfortable playing in that 20 to 30% private equity space. Again, depending on the underlying clients and the underlying opportunities, but one could probably extend that 20% to around 30%. The chart is a little bit outdated. Bond market, like I said, actually post this 2018, if you think about the previous chart, being 5 years annualized, has not been great. But again, the bond market becomes your ability to allocate to other things. In this example, you could increase your equity exposure, things like that. But again, going back to step one, that's driven by your asset liability model and what you're actually trying to achieve. There's no need taking undue risk if you don't need to. It just doesn't make sense unless you need to, or you're trying to achieve something that requires you to do that. So again, using step one as the roadmap or the compass to this portfolio construction part of the equation. In the next slide, I just look at ways here of again, potentially ways to generate a free lunch, potentially ways to generate some outperformance, ways to use active managers to rotate between the different styles or sub-asset classes. This is not a debate around active managers versus passive exchange traded funds. It's merely to show a point. For those that have dealt with me in the past, you'll know that we actually have a very agnostic approach towards active and passive managers, and we believe that each one has a role to play within a portfolio. So I don't want to get into that debate now. I just want to show that in our first example, we look at a random active manager relative to its benchmark, which is the S&P 500, which happens to be one of the biggest indexes in the world. And we just understand that what role manager selection can play, right? So you essentially have the active manager in the first column generating a return annualized in US dollars over the last 5 years of 17.3. The benchmark S&P 500 generating a return of 15.23. So you can see there that there is some outperformance just looking at return. If I move to the next block, which is probably a more interesting one for me, it looks at the standard deviation, which, as we discussed previously, is just one of the many measures for risk. And it shows that over that same period of time, the active manager taking on slightly lower levels of risk relative to the index. The third block looks at alpha. Alpha is another word for outperformance. It numerically aims to understand what that outperformance looks like relative to risk. And as we can see, this person is doing a higher return at lower levels of risk. So he's rewarded with a positive alpha number there of around 4. And then I show relative return as well as correlation. Relative return for this example is not overly important. Correlation looks at how close the holdings or the movements are relative to the particular index. So you can see that it is quite high, it is quite close, but there's been some key decisions along this 5-year journey that have resulted in outperformance at lower levels of risk. So again, just highlighting the ability to use instruments here within the portfolio construction that can also increase return and decrease risk. So similar to the chart we looked at before with private equity as an example, this just shows how one can do it in the listed market space as well. Again, not trying to say which one is better. We typically use both in portfolios, but important to understand the role that they play. Even if you're just using an active manager, not necessarily to outperform, you're looking at outperformance as a bonus, but rather to protect on the downside through those lower levels of risk. So if you can save a few percent when markets move down, that's also viewed as outperformance, right? Because you're not going all the way down the same way another holding would. And then again, just looking at another example at the bottom, instead here, I look at a manager who uses the MSCI World as their benchmark. So a bit more global approach compared to a US-centric benchmark like the S&P 500. And again, these kind of opportunities exist where you've got guys historically generating higher returns at lower levels of risk. We can see that once again with a strong alpha. Okay, moving on. In this section, you will notice the inclusion there at the bottom of what Scott affectionately refers to as the bucket approach, which I'll touch on shortly. But really, number 5 looks at the individual client or person's personal outcome and goals. Here, it's important, like I said earlier, to establish or determine what this particular pool of capital is trying to achieve, right? If it's a short-term goal, if it's a long-term goal, they're going to have different characteristics to it. You're going to invest that money slightly differently using the process previously discussed. So again, very important to understand what that outcome is or what you're trying to achieve. Again, any defined outcomes other than retirement, defined being the key word there. I want to buy a car in 3, 5, 7 years, or a house, or a yacht, or a jet, whatever that might look like for you. It's important to understand that or make someone aware of that when you're entering into these planning stages, because there is different ways to treat that. The most popular one is the last one. Again, this is personal scenario dependent. It's not for everyone. It is for a large amount of people, but it's not for everyone. This looks at retirees and the bucket approach. So in a nutshell, we break this down into 3 buckets or portfolios or baskets, whatever you want to call it. And those three buckets are the income bucket, the essential capital bucket, and the growth bucket. Now, these are already broken down into time horizons, right? So we had quite a bit of discussions about this last time, but I try and give those time horizons there. Income bucket targets 3 to 5 years, essential capital bucket targets 5 to 7 years, and the growth bucket targets 7 years plus. Now, for retirees, the asset liability model process looks a little bit different, right? And for people who have used the earlier version and have built up to retirement, when retirement kicks in, things typically change. Right, and they move into this bucket approach. And what the bucket approach tries to achieve is that it knows that you're going to require an income from the portfolio, right? And the goal of it is to separate different pools of capital for different outcomes or goals or objectives or whatever you want to call it. But ultimately, that income bucket of 3 to 5 years is there to provide you with income for that time period, right? It is typically invested into things that are less volatile, that are less risky, and with it generate a slightly lower return, right? So you want to, in other words, protect that capital at all costs, right? Because that is your pool of capital for the next 5 years where you're going to be drawing an income from. You don't want to wake up one morning and markets have fallen out of bed, and all of a sudden you're forced to draw income off a capital balance that has greatly reduced in capital, right? Because the long-term effects of that, depending on the drawdown, can be catastrophic, right? You're decreasing the capital amount, and in the future, when the market recovers, your recovery is off a much lower capital base. So your monetary return on that capital is significantly reduced, right? So that would be a worst case scenario. So you want to ensure that that capital is safe and it's protected by being in the correct investments for that particular bucket. When we move to the essential capital bucket, we have a time horizon there of roughly 5 to 7 years. The reason why we do that is because it correlates quite closely with the average market cycle. And it means that if we've got our income bucket protected for 5 years, we know that the rest of the portfolio, we can increase the risk profile a little bit, right? Because we understand that with income taken care of, you have the ability to stomach increased volatility in your essential capital bucket, meaning that you can target slightly higher returns because you can have more risk on that portfolio. So it's important to understand how the role that they each play. In that essential capital bucket, let's just use it loosely here. In the income bucket, you would be targeting things like income funds, investments that have allocation to cash, as well as a little bit of bonds, maybe pref shares in property. Those kind of relatively low risk investments that are going to generate a decent return for the amount of risk that you take. When you move into the essential capital bucket, you can increase that risk profile. Maybe you might look at the inclusion there of some equity. Historically, we know that equities generate the highest return, but they also are the most volatile. So we can look to include some equities there to bump up the return profile in that essential capital bucket. Lastly, in the growth bucket, this is a portion of capital that's set aside for 7 years and longer. It's our high risk, it's our high growth, it's our high return bucket. Typically, you'll find things like private equity with the longer term time horizons in this bucket. You'll find things like equity funds, that kind of stuff. That will all find its way into the growth bucket, because we know that with our other two buckets ticked, we don't need to be reliant on that bucket for that 7 years and longer time period. It can be invested, and it can go through its whole investment life cycle without us having to worry about drawing down any kind of income from it. So whether it goes up or down throughout that 7-year period, or whilst it goes up and down through that 7-year cycle, one doesn't need to wake up and stress about losing money or drawing down from a lower capital base. What happens post these time horizons is somewhat of a waterfall effect. Once your income bucket is depleted, the idea is that your essential capital portfolio would have moved through its investment cycle, and profits can be trimmed from that essential capital bucket and topped up into the income bucket. That would then essentially start the next cycle. When growth assets start to mature at the end of their life cycle, profits are then trimmed from that and allocated to the essential capital bucket. And then as I'm sure you can understand, that kind of kicks off the process or the cycle again. And you've got this continuous waterfall effect where you're constantly taking care of from an income point of view, and you're positioning your assets in the right categories, so you're giving them the highest likelihood of success. The worst thing that you can do is kind of interrupt a particular asset's life cycle and make rash decisions, and start to chop and change or pull money out when it hasn't kind of worked through its full life cycle. All right, I'm hoping that makes sense. In terms of the asset liability model, when you plan for something like this, your parameters change in that you will be making different assumptions on the different pools of capital, and you will be basing the size of the pool of capital off your income drawdown. So income is always going to be the key kind of driver of this whole process, and therefore the size of your portfolio and the size of the bucket will vary based off your personal situation, right? And then we assign different return assumptions based off the different buckets and based off the portfolio construction strategy for each different bucket. All right. Moving forward, onto the last.
Anthony, sorry, Anthony, just before you go, did you see Mike's question about the three buckets?
I didn't know.
I'll read it to you quickly. He said, in which of the three buckets would a retired person place Scott's property deals, e.g., a data center in Asia, a commercial property in the US that already has a tenant paying, a mixed use in Germany?
Yeah, good question. I don't know all of those deals off the top of my head. I'm assuming their time horizon is probably north of 7 years or thereabout. And because of that, they would go into the growth bucket. Again, it's private equity in general is somewhat of an illiquid asset class. So you're not going to place it in your income bucket, knowing that the income or interest payments are not sufficient to match your monthly or annual income requirement, because you're not going to be able to draw capital down if you need to. So because of that, it starts to push out the time horizon, and it's better suited to something like essential capital or growth. If that time horizon was more in the 5 to 7 year space, relatively low risk investment, good interest or income characteristics associated to it, then maybe it would fall more in the essential capital bucket. But importantly, it's understanding the nature of the underlying asset and its time horizon to group it in the right place.
Let's just while we're on this, let's just because I think it's actually a great question. So, like, if we take ABF, the Austin Business Finance 3-year investment, income producing deal, or the Manhattan deal where it was a debt deal, 18 months, purely income, where would you put those?
The ABF loan and Manhattan would more than likely form part of the income portfolio. Again, personal circumstances around whether or not that interest rate is covering the full income requirements or not. Maybe they're used as a supplement to something else that can be leaned on for additional drawdown. But typically they would form part of that bucket. I think the next one that you mentioned was the German property deal. That, if I'm not mistaken, has a time to maturity of between 5 and 7 years, probably on the lower side of that. So you would be grouping that in the essential capital bucket. Another key differentiator there between the two is one is debt that pays an interest rate. The other is equity that one can expect some kind of equity return or equity upside to it. So equity, when there's that compoundability, it starts to creep its way into the essential capital portfolio. Again, whether there's a supplement there around the income side of it going into the income bucket or the income portion of that particular deal is again on a personal circumstance base, or whether that income is used to reinvest into something else is also debatable, again on personal circumstances.
Perfect, thank you.
Cool. Okay, moving on to the last slide. Fairly straightforward, fairly self-explanatory. Just looks at the monitoring, measuring, and rebalancing. Obviously important here to kick the tires, make sure that performance is being monitored relative to benchmarks on a quarterly and annual basis. Quarterly is probably a bit premature. Again, it's something that you want to keep an eye on, but you don't want to be looking at it all the time, right? Markets move up, markets move down. Things like private equity remain relatively static in their pricing for a prolonged period of time. So you don't need to look at it from an ALM point of view. You don't need to look at it too frequently. But obviously just important to make sure that you've got a grip on everything. If there are any steam trains heading for you, the ability to rebalance and reposition ahead of that is obviously always a great idea, and you can only do that if you've got a handle on what's going on. Secondly, monitoring performance relative to the financial plan and ALM. Like I just said, this can be done at longer intervals due to market cycles. You might have a year like 2022 where markets are down. It's really not going to help reevaluating these things on a monthly basis. It's much better to do it now once you've seen the recovery play out, and just make sure that on an annualized basis, one is kind of there or thereabout where they need to be. If there are any changes to circumstances, it's important to identify those and readjust the ALM parameters and remodel this. Let's say you intend on retiring earlier, or you intend on giving one of your grandkids some money or anything like that, any kind of parameters that can affect the ALM. It's important just to make note of them and adjust or change things if need be, because they can have a material impact on the way things look going forward. Lastly, rebalance the portfolio if there have been any significant changes in the parameters, or if specific targets have been met, reallocate to investments that offer greater upside potential. So again, if a pool of capital has been removed for a property purchase, but it actually did better than expected, and there's some left over, reallocate something like that. If there's need to move between sectors or sub asset classes or things like that, then that obviously must also be done. But I think, like I said, this is pretty straightforward and self-explanatory. And that is it, Scott.
There's a question here from Mike where he said, so if I invest in private equity deal that is likely to mature in 5 years, then 3 years after my initial investment, could the asset be included in the income bucket?
No, because it's still going to be illiquid, and it's those time periods are essentially from the start, right? You're not going to juggle buckets throughout the course of it, because again, if that was there and let's say you need to draw more income because of an emergency or something like that, you're not going to get it from that illiquid asset, right? Even though it's close to its term to maturity, you're not going to be able to just take out half of your investment at a whim. So again, it's important for it to remain in that bucket because it's still got that time to maturity. Once it matures and the capital pays out, then one would start to reevaluate the buckets and say, okay, should I be topping up my income bucket because I've had a maturity or a realization in my essential capital or my growth bucket? That's when I would be looking to make those changes or asking those questions. I wouldn't be doing it prior to an actual realization of the investment.
Can I suggest we just stop sharing so we can see a little bit more? Kathy said, hi Scott, I have a question on this. Might be a bit long. So just for the record, Kathy and anyone else, there's no such thing as a too long question or even a question that people think might not be stupid. I would go as far as to say the only stupid question is the one not asked right now, because firstly, thank you very much, Anthony, but now's the time to ask the questions to get context to what you just heard. So, okay, you have 30 million, Anthony mentioned, and retires today. You need 1 million per year. So do you put 3 million in fixed interest as an example for the 3 years, and then 10 million in the 5 to 7 year as an example, and 17 million in growth? Do you pull out each year from essential capital and growth and move into the income generation? How practically does the timing work?
Okay, let me just try to think of that. So again,
do you want me to just, sorry, do you mind? I'm just going to post that to you directly, Anthony, so you can actually just read it, because I don't know about you, but I'm a visual person as well. So I'll put it in the chat box for you so that you got it as well.
Again, I mean, obviously this would all, one would need to model these scenarios and understand what the outcome would be, but let's try and answer it using basic numbers. So if you were to put 5 million or 5 units aside in your income bucket, assuming you're needing 1 million each year, right? You would in very basic terms have 5 years worth of income, right? The assumption there is that there's no return on that asset, right? If you were to start adding 2, 3, 4, 5, 6% return to that asset, you would get a lot more sustainability, and that 5 million number would come down a bit. Again, depending on the parameters that you associate with it. The amount that would go into the essential capital portfolio would again be based off some kind of return assumption that you associated with it, and it's very basic form, assuming no return. We've got 5 million now in income, and we take 7 million for the next 7 years into the essential capital portfolio. That leaves us with 12. I think in the original example it was 30, which would make the assumption that 18 would go to the growth portfolio. You would then, at the end of the 5-year period, when that income bucket is getting low, you would look to your essential capital bucket that's now had 5 years of untouched growth to start to trim profits there and rebuild up your income bucket, right? So you're creating that waterfall effect, and then at a point in the future, probably a couple of months, maybe a year, maybe 2 years. I mean, these things do not work out to the exact day. You would then be expecting some kind of redemption event, or a scenario in which that your growth portfolio has had adequate time to move into profitable territory, and you would be then filtering down from growth into essential capital. Does that make sense? And you've got that kind of waterfall approach, and then you entering into the next cycle of that phase.
Yep, no, that makes sense. Sharon said a question here. This question may be more for you, so me. Do I understand the nature of the deals on Wealth Migrate? Do they provide monthly income? Yes. Depending on how much one invests, one could include that monthly income in the income bucket. No. So again, Sharon, we do have different types of deals. Some of them are monthly, some of them are quarterly, and some of them are half yearly, and even one of them is annually. I mean, the Carry-Fit deal is an annual deal, as an example. I would say on average, if I look across the last 10 years, the most common is generally quarterly, just in terms of income, in terms of payment. But what I'm hearing, and by the way, I learned this today as well from what you just said, Anthony, is that yes, the income is there, but because you can't spend pieces of the capital, you only get the income, you can't spend the capital, is that it wouldn't be part of the income bucket unless it's probably shorter than 3-year time frame, is what I've just understood from what you said maybe 15 minutes ago.
Yeah, I mean, you're correct, right? The actual equity upside, again, talking deals here, in a specific deal would be in that essential capital portfolio, where it would resort back to personal circumstances, which is always kind of the overarching theme to all of this, right? Because I can't say it enough. Everyone is different. There's no one size fits all here. If the particular person was reliant on the income payments for their monthly or annual income, then you can supplement with that in the income bucket. If you've got a scenario in which that income from the deal takes care of all your income, then you're in a fantastic position where you can be fairly reliant on that income payment, right? So you're kind of ticking 2 boxes there. This assumes that the person is actually retired as well. I mean, if you're not retired and you are looking to aggressively compound your capital base, you're going to want to obviously hoard as much as that income as possible and reinvest it so that you can grow the capital pool to a greater amount, so that when you do retire, you've got a larger capital pool to retire off. So it's about personal circumstances. It's about understanding what you're trying to achieve, and it's about using each specific characteristics of different deals or markets and things like that to kind of mash them together and construct around those parameters.
But that's why, if you don't mind, I'm actually just going to pull up a slide. I know you've updated your slide, but let's. I'm still using the old slide, but let's just use it quickly because I think it sums it up lovely. Just in terms of it's this one here. If I share my screen, this is why I think this slide is so powerful, because we've got you've got this multifaceted approach that you're talking about, because you've got the individual circumstance, you've got the Enneagram, and you've got the asset liability modeling, and that's what helps you build your portfolio construction. And I think as I understand it, that's what you keep overemphasizing to everyone. And also, if people haven't done the Enneagram and wealth, you can now start to see why that's important. Then you've got the personal circumstances, which is why you have the one-to-one health check. And then obviously the model is just one part of a three-piece puzzle, in terms of where we're at.
Yeah, 100%.
Marina asked a question. As you know, crypto has shot up. At what point do I sell and move over to something like ABF, as I'd like to create income? Is there a rule, for example, on when to rebalance?
Sure. Crypto and
talk about two ends of the spectrum, one that gets you income with no capital growth and one that's only about capital growth,
Yeah. And one topic that puts me in front of the FSCA and one topic that doesn't. So let me tread let me tread lightly here. I think
well, firstly, we're not providing financial advice. So just at in terms of a holistic view, it's quite important to say that. And the second one is that there's the crypto is a very I'm helping you out here a little with Anthony before you open your mouth. So crypto is a very, very contentious issue that is quite murky at a regulatory level to be able to provide advice on. So what we could do is refer to something that is having a extremely high growth, even like a tech stock.
Yeah. Again, I mean, if you doubled your money, if you got in at 80,000 and it's now at 87, I mean, it's not the meteoric rise that a lot of people have experienced. If you've got in really cheap, I wouldn't be opposed to buying low and selling high, right? I think that's kind of the core DNA of investing. If that is a scenario for you, if you're in that position, then I don't see anything wrong with taking a little bit of profit off the table. I don't see anything wrong with taking everything off the table and leaving your original amount in. So kind of deleveraging yourself completely. If that's for a scenario you're in return wise, there's multiple ways. Maybe you think this thing is going to $1 million, and you're with it for the ride, then that again is a personal circumstance. If you are in a position where you need the income or you need something to generate an income, then you need income, right? I mean, you need to start making those kind of decisions, and after a really strong rise, it probably isn't the worst time. So again, personal circumstances, always good to take profit. Nothing wrong with taking a little bit of money off the table every now and again, unless you feel very strongly about it and you think there's still more legs. Yeah, I hope that answers it in a very roundabout way.
No, awesome. Okay, well, are there any other questions? Going once, going twice. Marina says thank you. Anyone else got any questions in terms of the 6 pillars to wealth? I do remind you that we did this on a wealth weekend, and Anthony expected to talk for 45 minutes, and 2 days later, he had run out of time and his voice. So there's a huge amount of depth one can go into in this process, and I don't think this is a topic that we can ever have enough of, quite frankly, in terms of that process, because it's always like, what does this mean? How do we go deeper? But why I think this is so important, and there's certain people like Damien that have joined this call where I said, look, I think this is really important to be part of this call, to understand the essence of the framework of how a family office works. What is the basis? How does this, how does it all get put together? Because it's easy to say, oh, we're going to build a plan. What does it actually mean? What are the foundations? What are the pillars? And so I hope it's really, really useful for people to kind of get a context as to how it all comes together. Judy saying, good to review again. Archie saying, thanks, Anthony, great overview. Sharon saying, no more questions from me. Just want to say thank you. This has been so informative and kept my interest the entire time. You are a great educator. Jeff said, thanks, Anthony, much appreciated. And Mike said, sometimes does the income bucket get completely depleted in retirement?
Yes, like the purpose of the waterfall approach is you are depleting it. You're depleting it on each of those cycles, but you're obviously topping up from other sources. So you're working through that cycle. Income bucket is on its last legs towards the end of that 5 years, taking profit from essential capital portfolio and growth portfolio and watering it down. The the key is to make sure that everything else is planned correctly so that that can happen. You'll never get a situation, if planned correctly, where all of your capital runs out, but the idea is to cycle it through those different time periods.
Just my interest, I don't know the answer to this question, but the traditional financial industry, how much perspective are they using when I go and meet, Jill or Joe Soap, and they, just giving me my typical financial advice? How much of that is related to this bucket approach, if you want to call it that?
I don't know. To be honest with you, I'm not sure what the other guys are using. I mean, we've been using this approach now probably 10, 15 years. I mean, some of our clients who you know very well and have spoken have been using this for multiple years. And if done correctly, it I don't want to use the word bulletproof, but it does become quite bulletproof in the sense that you're giving the assets the necessary time to do what they need to do, right? You cannot look at something like equity and isolate it to 1 year. You look at 2022, S&P down -22, -25 at times, and say, this is not going to work. The whole point is to kind of create that sustainability and create that ability to see out different time periods and stomach volatility, so that at the end of it, you can get the increased return from asset classes like equity and stuff like that. Yeah, I see Evan's comments there. I wouldn't be surprised if this has been adopted more broadly, because I mean, in my view, it's kind of the only way to do this. If you're not doing this, then there might be some potential alarm bells going off.
Excellent. No, I'm seeing that Evan and Sharon are saying that. I think it's a great, it's a very illuminating for people, because if you're not getting this, then really you need to ask yourself why not. But it's good to see that some people have experienced it elsewhere. I know certainly from your perspective, I first heard about it and have seen it through yourselves, and I haven't. It's not common practice. Generally it's not out there in terms of what most people are actually looking for.
Yeah, there's risk modeling and stuff like that. That, like I said, is not really our favorite way of doing these kind of things. But the problem, I mean, even with the bucket approach, the problem can come in if you're not correctly assigning investments, the right investments to the right bucket, right? So if you've got equity funds in your income bucket, you've got a problem. Because whilst markets are going up, it can be fantastic. It's all smiles. But if markets come down, you're going to see that whole thing unravel pretty quickly. So even if you are employing this kind of approach, maybe just kick the tires and make sure you're completely comfortable around the different investments that are fitting into the different buckets, so that you've got peace of mind that it's a robust strategy.
I think there's a great question to probably end off here. And Damien's asked a good question around legacy. So how does the waterfall approach help with leaving a legacy?
That growth bucket is the key driver of legacy. Again, it's your longest return type of bucket, and that is leaned upon quite a lot for the legacy component. Again, your longer term investments that can be passed down. Some clients that, let me not say wealthy clients, because it's not only isolated to them, but clients that have sufficient capital relative to their income, they can sometimes go through life not even touching that growth bucket. I mean, that growth bucket just never gets used because there's no need to use it, right? You've got sufficient capital in your essential capital bucket to continue topping up your income bucket, and for your lifetime as the primary breadwinner, you might not even go close to that growth bucket, right? And that's when that's when you can explore all those kind of longer opportunities. You completely understand where it fits in from a growth point of view, from a timing point of view, and that bucket's never touched. I mean, you've got guys running equity portfolios for 20, 30 years and they've never made drawdowns from them because they don't need to, right? And that again can form part of the legacy and does form part of the legacy section of it.
Awesome. Okay, well, I want to wrap up and say thanks very much, Anthony. We are going to, and I did mention this earlier, we are going to wrap up the year when we do our December session, where we'll review the year, we'll review all the lessons, and we'll start to pivot and move forward into next year. I had a little video that was made for me recently, and it's a very short little video, but I love it because it's one of the greatest lessons that I learned this year, actually, which is all about asking great questions. And so when I look at what Anthony's taught us today and many of the things that you've taught us all through the year, my strong recommendation to you is start to think about what are the great questions that you'd like to ask coming into the final session for the year. And I want to play this little video for you because I think it sums it up, and then we'll say cheers to Anthony. So let me play this for you quickly in terms of asking great questions. If you ask stupid questions, you get stupid answers. If you ask great questions, you get great answers. And one of the things that I'm learning as I'm getting older is that we all deal with chaos. We all deal with problems in life. We all feel uncertainty and the world kind of overwhelms us. It might be in your personal life, it might be in your business life, it might be in your financial life. I don't care how successful you are. There will be times when you have a dark night or a troubling time. And what's so interesting to me is as I've got older, I've learned more and more to ask great questions. And when you ask great questions, you tend to get great answers. But what you also have to do is have the patience to wait, to listen, and to hear your intuition. So it's a little bit of fun to finish off from Anthony, but my strong invitation to all of you is get ready with your questions so that you can ask great questions. Anthony, as always, I deeply appreciate not only the initial session in terms of where we've come from, because it's been a bit of a tumultuous month, but also kind of the session you've just given us on the 6 pillars. It really does mean a lot to me from a community perspective that they can get these insights and that we can all not only just learn the theory, but actually implement it. So if anyone's missing any of these pieces of the puzzle, then please reach out because they're all at your fingertips to be able to implement personally yourself.
Awesome. It's a pleasure. Thanks for having me.
Awesome. And there's lots of comments, nice comments coming through. So saying thanks very much to you in terms of that process. Okay, awesome. Let's pivot then in terms of where we're at. There's lots of thanks to you, Anthony. So wonderful in terms of your time. I just want to finish off with some admin for everyone in terms of the process. I always like to finish off the month and say, can I ask you a question? And again, reminding you that this is where your comfort zone is and this is where the magic lies. So a couple of things that are important. I know that Alex has been talking to people about accountability partners. So we always want to work on accountability partners, reminding you that you can either have accountability partner, or if you want to just take your own matters into account, you can literally go to school, you can go to the community here, and you can literally put a post in here and say, right, like looking for an accountability partner, who wants to join me, etc. Maybe we should make a post just for accountability partners, and people can find other accountability partners in terms of that process. In terms of collaboration, I remind you that tonight, again, we've got the fireside chat. So this is where we get together and we talk about, what we went through today, what Anthony's taken us through in terms of that process. So we'll do an FAQ or Q&A in terms of everything that we've discussed. We'll also go through and I'll answer any questions around the presentation I gave around being a global citizen and the generational opportunity and how technology is literally changing the wealth, the investment, and the real estate space. And then we'll also talk a little bit about the passive income challenge. So I'm about to go into that in more detail if you aren't aware of what that is all about, and giving you access to that. Then in terms of the Wealth Weekend, if I've already referred to it, but just in case you didn't hear me, the Wealth Weekend is here. So whether you're at the Wealth Weekend or whether you weren't at the Wealth Weekend, everything is here. So you've got the 6 mega trends to wealth that was run by Garth Wellman. You've got Enneagram and Wealth, which was an entire day where Karen and Bianca took us through in 3 different modules. And then you've got the generational wealth, which is actually 5 modules, which was taken through by David Lipschitz in terms of that team. So that is all there. If people want the pictures, I'm not quite sure how to share the pictures, but I was actually thinking it'd be quite nice to put up the pictures here in terms of this process as well. Then in terms of school, I think I've just shared with you where all those details are. In terms of the mastermind, so it's time to plan for 2025. And so what we're going to be doing in the final month, and I'll talk to it now, but ultimately now as we go into December, it's all about wrapping up for 2025. I've already given you all the calendar dates for next year. The only ones we haven't done are the Wealth Weekend and the personal meetups, like Alex has already referred to. I'm just trying to finalize some dates with the Calio team, but they will be done by December. So by the time we have our next December session, everything will be in the diary for 2025, so you can plan your year fully in advance. I do remind you that there's the 3 levels. So you've got the transactional and the transformational coaching. And if you want to work with me one-to-one, you can. But, go watch the video. Again, just to remind you, sorry, I should probably just show you each time where these things are. So if you go to the classroom and you go to step 7, you can literally go down to what is the difference between, transactional coaching and transformational coaching. It's here in step 7, and there's a video that I've made to explain it in terms of that process. And then in terms of Wealth Migrate versus Private Wealth Global, I know that Rael said to me, Scott, that's not very clear. So again, we've made that clear for people. If you go to step 9, you can literally watch the video where I've explained what is the difference between Wealth Migrate and Private Wealth Global, and what does it mean to you as an investor. And then just in terms of the workshops, we had the workshop in Johannesburg and Pretoria. It was lovely to see so many of the Mastermind members there. We had a lot of fun on Saturday evening, and we're looking to repeat that in London. So those of you that are in England, I am just confirming the dates with Paul O'Mahony in the next day or two. But once those are confirmed, I'm currently looking at the first week of December. If we can make it happen before Christmas, if we can't, it'll be at the end of January. And then if you want to invite your friends, like I said to you, not only, I did actually explain this at the weekend. If you look at that modeling, it kind of works like this. You either need more money and less time, or you need, less money and more time, in terms of getting to your freedom. The only other option is if you don't have a lot of time and you don't have a lot of money, the only way to do that is to accelerate value by adding value to other people. And that's really where, if you go back to here, we've literally put it in here where you can share the love and invite a friend to be part of the process in terms of where we're at. So yeah, if you are interested, reach out to Alex and I, and we'll happily help you with that. Alex is always available to sit and to meet with. So, if there's something that is not working or that we can help you with, I know a number of you have had meetings with Alex, and you can use the online platform to book a meeting with Alex in terms of it. And again, I'm going to keep going back to this, because if you go here, under step 9, you can book a meeting with Alex. Under step 2, you can book a meeting with Alex, in terms of straight through to Calendly link in terms of that process. Then something we've spoken about a lot, which we are super excited about, and I just want to share with you a screen here. So I'm going to stop sharing this. You might or might not have seen this before, but let me just share my screen here. And I need to just give me 2 seconds. Where's it gone now? Why is it not working?
Scott, we saw the notepad. We can see it.
Yeah, no, it was just
I think we're seeing the wrong notepad at the moment.
Yeah. Okay, hang on. I'm going to stop sharing. I'm going to try to do this again. Just give me 2 seconds. I'm sharing the one from today and not that. There, I got it now. So this is something that I can't remember if I've shared at the mastermind level, but at the end of the day, you all joined the mastermind to get a result in simple terms. And so what we've done is we've built out the passive income challenge. And the whole idea is that Jill and Joe Soap are here, and you're sitting in your bed, and you've got an asset, and you want to make money while you sleep. And what we realized was that whether you join the mastermind or even some of the other things, you come on the platform, you don't know what to do, you meet with Calio, you attend all the sessions, but ultimately there's lots of noise and it kind of falls off. And we said, well, right, how do we get someone from A to B as quickly as possible? We're calling it the blue dot. which is ultimately about getting them the passive income as quickly as possible. So if you're already on the Wealth Migrate, platform, you don't need to necessarily do the challenge if you're already on it and investing. But if you're not, then we basically created the passive income challenge to help someone. So what we do is we unlock the passive income stream in less than 30 days. It starts the 18th of November, so it literally starts next week. And the idea is to take you on a step-by-step, so literally over 4 weeks, do this, do this, do this, and do this. There's 4 steps to be able to get the result. Ultimately, to be able to earn a passive income by Christmas and enjoy the holidays with peace of mind. And you can literally go to the link in terms of the passive income and make it easy for yourself. Maybe actually Shane or Alex, if you can just put in there, I see I need to update that link because it should be the 30-day passive income challenge in terms of the process. Why join? Well, you'll get results in 30 days. So achieve a passive income in just a month. Earn while you sleep. So imagine your money working for you 24/7. The challenge is designed to help you achieve that. Step-by-step guidance will walk you through the entire process, including setting up and seeing income flow into your wallet. Each week comes with focused actions to make the process possible, and you'll have community and accountability. So a group of like-minded people to help you stay motivated. Now, as an example, Kathy, with your 2 daughters, this might be a great opportunity for people to get their children to participate, because literally they can start from $10 and go through the process. The goal is to set up and earn a passive income within 30 days. We're literally starting, we're doing a bonus session today, and then we officially start next week. And all the steps to achieve income within 30 days. This is how it works. So, week 1 is about setting up your financial goals and joining the group. Then it's about completing your KYC and setting up your wallet. Then it's about funding your wallet and identifying investment opportunities. It's about making your first investment. It's about tracking results and optimizing your strategy. And it's about celebrating and having fun. And the whole idea is to unlock the passive income in just 30 days. Who's it for? Well, it can be for aspiring investors new to passive income and want to learn the ropes. It can be for seasoned investors looking to explore new opportunities and strategies. And it can be for busy professionals, those wanting to earn an income with minimal day-to-day involvement. What the tools and resources, you'll literally be helped with your KYC and wallet setup, weekly webinars, community chat, certificate of completion, and advanced webinar access for early registrants. And then in terms of the milestones, milestone 1 will be to get your KYC and your wallet set up. We want to achieve that within 7 days. Milestone 2 will be your first investment made. We want to do that within 3 weeks. And then milestone 3 will be tracking your income and ultimately celebrating, and there's going to be prizes for people that actually achieve this. And then just some FAQs. What if I've never invested before? No problem. This challenge is beginner friendly and offers step-by-step guidance. How much money do I need to participate? You can literally start with whatever you feel comfortable with. We'll provide for small and large investments. And then what happens if I miss a webinar? Everything will be recorded and shared with participants. You won't have to miss a thing. And so I just wanted to share that with you. And then some people have also mentioned the mindset challenge. So you've all got access to the 60-day challenge, which is just a mindset thing. Each and every one of you have done the one-to-one session with me, and I talk about the massive impact that this has had on me. My strong recommendation is that you actually try to do both in parallel. So I'm going to be restarting the 60-day challenge on Monday. So that'll be Monday, the 18th of November. And literally it's just to get our mindsets completely on track, to get clear on our outcomes so that we go into next year with a super strong mindset. And then with regards to Wealth Migrate, specifically the passive income challenge has been used to help people get on the platform, to get themselves set up and to start investing. If you do want to own a piece of our business, so if you enjoy what we do at Wealth Migrate and Wealth University, then, if you haven't seen the recording, we can share the recording with you and you can be part of the generational opportunity. And then next month's fireside chat. So this is the homework for next month. We're going to review what we have in terms of our top 3 outcomes, our top 3 priorities, and our top 3 measures. So whether you did your one-to-one with me 2 years ago or a year ago or in the last month, what we want to do is we want to review. You personally need to sit down and you need to review your top 3 outcomes, your top 3 priorities, and your top 3 measures, because every year we should be doing it annually so that next year, every single month, we're checking in with our actions and our daily activities and tasks to turn these outcomes, priorities, and measures into reality. And then something I enjoy, which we started a couple of years ago, which was, what is your work for the year? I meant to say word for the year there. Word for the year. And I just put this in because I love the one we got this morning, which was by, I think it was Glenda, which was dial back and tune in. So whether it's one word or a short phrase, I don't really mind. But it's like one specific key focus for the year in terms of that process. So that'll be the session for next month. So that's the month of December. We always do a review of the year. So Anthony will come in, he'll review the whole year for 2024, and then we'll look forward to 2025 and what we should be looking at as investors. So we'll look at that at a holistic view, and then at a personal view. My invitation to you is to have done this work beforehand. So because what we're going to do is that each of us will get so we actually have an extended fireside chat at the end of the year. So this entire morning session is a fireside chat where each person gets to check in, like, right, what are their top 3 outcomes? What are their top 3 priorities? What are their top 3 measures? They can talk to them. They can ask questions. They can get clear so that you go into next year knowing that you have your top 3 outcomes, priorities, and measures in place. And then obviously you got your word for the year. And so that is what step 8 and step 9 is all about. I do remind you that I'll stay here if anyone's got any questions in terms of the accountability and the check-in. But I do want to finish with the great man Nelson Mandela, who said, money won't create success. The freedom to make it will. And I've always got this little video. And
I have walked a long walk to freedom. It has been a lonely road, and it is not over yet.
So Nelson Mandela, and I never actually know, can people hear what he said there? Because Zoom's got so clever now at listening. But anyway, he said it's been a long road to freedom. And I think for us, the whole journey of wealth, the whole journey that we walk is a long and lonely road. And that's why we're part of a community together so that we can work together. So I hope you enjoyed today. We'll put the recording up into the link for anyone. I hope you enjoyed the Private Wealth Global. As Alex said, that's about 200 hours worth of work that's been put together to put everything in one place to make it really easy for you. And I hope that you enjoyed the 6 pillars to wealth that Anthony's taken you through so that you've got a full understanding of how the family office works and how they can help support you to achieve your results. Alex, Shane, anything I've forgotten or anything that's important that you think is relevant for the Mastermind members before we close out for November's morning session?
No, Scott, I think you made sure that everything is covered. I just think that one of the most important things is if you have not gotten your profile verified on the Wealth Migrate platform, let's just get it done, as Derek would say, because one of the key things is I just want to make sure that everyone's set up for success for next year. So if you haven't gotten it done, I've been working with a number of Mastermind members now over the last five days, basically. So yeah, let's just get it sorted and make sure that we don't have to worry about it next year. So if you need help, just reach out to me and let's get it sorted. Thanks, Scott.
There's an important question that Sharon's asked. With regards to the passive income challenge, it's available to everyone. So we really want to fulfill our purpose of helping everyone invest like the top 1%. Obviously, Mastermind members will get top priority, but share it with your children, share it with your friends, share it as far and wide as possible. Let's finish the year strong and have as big an impact on as many people as possible. So you've got the link that Shane has put in there, the 30-day passive income challenge.com link, and literally just share it with anyone, share it as far and wide. Let's help as many people as possible earn a passive income before Christmas. And yeah, that'll be quite exciting in terms of the overall process, in terms of where we're at. You know, I'm a very, very big believer that people have 2 choices going into Christmas. One is they can go to Christmas with an anxiety, frustration, and concern because they kind of wanted to do something. They wanted to, diversify, or they wanted to get passive income or whatever, and they kind of want, but they didn't actually do anything. And so they'll want next year to be different, but they kind of know in their heart it won't be. And then on the other hand, all of you that have joined the Mastermind, or even if people have done the passive income challenge, have actually done something, they've got a meaningful result, and they go into Christmas with a very different mindset, one of like peace of mind, knowing you've got the right partners, knowing you've got the plans, knowing you can get the results, and knowing that 2025 can be a very, very different year. So, I tend to call it, hell and heaven. On the one side, you've got hell of anxiety, and on the other side, you've got kind of heaven of knowing you can get results going into 2025. So it's really quite exciting in terms of that overall process. Shane, is there anything from your side that I've forgotten that I need to tell anyone about?
Yeah, I think you've covered everything. Yeah, all good. Nothing further to add. So.
Do you want to talk just to the link that you put in around affiliates? You said if you want to refer others to the challenge, they can sign up as an affiliate. So if you want to you can just do it if you want. You can just share the link with anyone. But if you actually want to be an affiliate and have it trackable and ultimately monetized, then there's a proper system that Shane has shared the link on. Maybe just share quickly how that works, Shane.
Sure, give me a sec. I'll share my screen quickly so you can see. Right, so the affiliate setup is pretty straightforward. You just go to that link, affiliates.wealthuniversity.org. You sign up. Once you get in there, you'll get a link that has a code. So it'll look something like this with your own unique code. And then you can share that with whoever you want. And then basically it just sends them to this page. When somebody signs up, it's going to refer them to our challenge, give them instructions on what to do, but then it links that person as to your name as a referral. But that's it.
Awesome. So my invitation to the Mastermind members is, why don't we all go out and try and invite 10 other people? At the end of the day, imagine we could impact 1,000 people by Christmas. Why not? At the end of the day, you can have anything you want in life if you help enough other people get what they want. If you want passive income, well, what about helping a lot of other people get passive income? So, yeah, that's my invitation. Let's spread it far and wide. Shane has built all the systems. It was his idea to help people get to passive income. Alex is actually going to be launching it. It literally goes live in 20 minutes in terms of the first bonus session. So it's very, very exciting. And please, I can't speak English. Share the love. Let's share it as far and wide as possible and have as big an impact on the planet as we truly can. And to Rail, is it possible to put a miner on the platform? Rail, where there's a will, there's a way. My son has been on for many, many years. There are some challenges coming out of South Africa, around the Reserve Bank, etc. But wherever there's a will, there's a way. And Nozipa said, thank you. Still very exciting, so still very inspiring, so I deeply appreciate that. And I think on that note, we will pivot and end. So I'm going to stop the recording now. Thank you all for the November session. I hope you found it of value. I do want to finish with the words that Anthony actually said, and I think it sums up the mastermind for this month. And he said, there's no such thing as a free lunch when it comes to investing, although diversification is seen as a free lunch. And I'll definitely be playing that recording again, considering I'm so passionate about diversification. To those of you who hadn't had a chance to do your one-to-one accountability, either come tonight to the fireside chat or stay with me. I'm literally going to stay online here and I can help you now. Cool, everyone. Have a wonderful month. Cheers.